Every financial crisis in history follows the same script. The people who caused it are rescued. The people who had nothing to do with it pay for it. This has happened so many times that it is no longer a scandal. It is a policy. That is not cynicism. It is the documented record. And the reason it keeps happening, the reason the script never changes even when everyone can see it, reveals something about the financial system that the system works very hard to keep you from seeing clearly. Not through conspiracy, through complexity, through the sheer volume of technical language that accumulates around finance like a moat, keeping the most important questions out of reach of the people most affected by the answers. So let us cut through the moat. A financial crisis is not an accident. It is not bad luck. It is not an unpredictable storm that struck without warning. Almost every major financial crisis in modern history was preceded by conditions that were visible to anyone who looked, and by people who were looking and saying so, loudly, and being ignored, dismissed, or actively silenced by those who were profiting from the conditions that made the crisis inevitable. The 2008 financial crisis did not begin in 2008. It began years earlier, in the quiet accumulation of a structure so fragile that a single disturbance was always going to bring it down. And the structure was built deliberately, piece by piece, by institutions that understood exactly what they were building and profited enormously from building it, right up until the moment it collapsed onto everyone else. Start with the mechanism, because the mechanism is what makes the crisis possible. And the mechanism is the same in almost every case, dressed in different instruments, different jargon, different decades, but structurally identical each time. The mechanism is this: credit expands, asset prices rise. Rising asset prices make collateral more valuable. More valuable collateral enables more borrowing. More borrowing drives asset prices higher. The cycle feeds itself. Everyone inside it is making money. The models say the risk is manageable. The ratings agencies say the instruments are safe. The regulators say the system is sound. The incentive of every participant is to stay inside the cycle as long as the cycle continues, and to get out before it stops. But no single participant knows when it will stop, and so they stay, and they borrow more, and they believe, or perform believing, that this time is different. It is never different. The cycle always ends the same way. When enough debt has accumulated against assets whose prices were inflated by the debt itself, the structure becomes self-sustaining only as long as confidence holds. And confidence is not a foundation. It is a feeling. When the feeling shifts, when enough participants simultaneously decide that the assets are not worth what the debt assumes they are worth, the cycle reverses with the same momentum it carried on the way up. Prices fall. Collateral loses value. Loans are called. Forced selling drives prices lower. More collateral fails. More loans collapse. The cycle feeds itself on the way down just as it fed itself on the way up. This is called deleveraging. It sounds orderly. It is not. In 2008, the assets were houses. The debt was mortgages, but not ordinary mortgages. Mortgages that were deliberately made to people who could not afford them, documented with paperwork that was falsified, packaged into financial instruments of such complexity that almost no one who bought them understood what they contained. Rated as safe by agencies that were paid by the institutions whose products they were rating, and sold to pension funds, sovereign wealth funds, and banks around the world. The entire structure was a mechanism for generating fees at every stage of a process that ended with risk being distributed invisibly across the global financial system, while the fees stayed concentrated at the institutions doing the distributing. The people making subprime loans knew many borrowers could not repay. The banks packaging the loans into mortgage-backed securities knew the underlying loans were deteriorating. The ratings agencies knew the models they were using were inadequate. The executives approving the structures knew the risks being taken. How do we know they knew? Because the emails exist. Because internal communications from multiple major financial institutions showed that people at senior levels described the products they were selling in terms that were incompatible with the ratings they were assigning them, and the representations they were making to buyers. The knowledge was there. The incentive to continue was larger. This is the part that the language of crisis obscures. A crisis implies something unexpected, something that happened to an otherwise reasonable system. The 2008 collapse was not something that happened to the financial system. It was something the financial system did. Deliberately, profitably, and with full awareness of what was being done, right up to the moment of collapse. Now watch what happened next, because this is where the script reveals itself most clearly. The institutions that created the crisis were rescued by the government, not the homeowners who lost their houses, not the communities that lost their tax base when property values collapsed, not the workers who lost their jobs when credit froze and the broader economy contracted. The institutions, the banks, the financial entities deemed too big to fail. A phrase that appeared in public discourse in 2008 as though it were a neutral technical description and was actually a political choice dressed in the language of economic necessity. The Federal Reserve extended trillions of dollars in emergency lending to financial institutions at near zero interest rates. The Treasury purchased toxic assets and took equity stakes in failing banks. The government guaranteed money market funds. The implicit guarantee that had always existed, that the largest financial institutions would be rescued because their failure would destabilize everything, became explicit. It was written into policy. It was paid for by the public. And then, once rescued, those same institutions paid their executives record bonuses within 2 years of the crisis. Because the crisis, for them, had ended. For the communities that lost their housing wealth, for the workers who lost their jobs, for the countries in Europe that were pushed into years of austerity to service debts taken on to rescue their own financial sectors. For those people, the crisis did not end in 2008. For some of them, it did not end at all. The Bank for International Settlements estimated that the total output lost globally due to the 2008 financial crisis, the economic activity that did not happen, the incomes that were not earned, the wealth that was not created was in the range of tens of trillions of dollars. The rescue of the institutions that caused it cost trillions more in direct outlays and guarantees. The people who caused it paid in fines that were large in dollar terms and small relative to the profits they had made, and almost none of them faced criminal consequences. The prosecutions that followed 2008 were overwhelmingly directed at small-scale mortgage fraud, not at the architects of the structural fraud that made the crisis possible. This asymmetry is not incidental. It is the system working as designed. The financial sector is not regulated by people whose primary allegiance is to the public interest. It is regulated by people who came from the financial sector, who will return to the financial sector, who understand the financial sector from the inside, and who share a mental model of the economy in which the stability of major financial institutions is the primary variable to be protected, because without them, the whole system stops. This is called regulatory capture. It produces regulators who regulate in the interest of the regulated rather than the public. It is not corruption in the crude sense. Most of the individuals involved are not taking bribes. They genuinely believe that what is good for the financial system is good for the economy, and that what is good for the economy is good for everyone. The belief is sincere. The belief is also structurally convenient for those who hold it, and the convenience of a belief is always worth examining. Now look at what crises reveal that normal times conceal. During the good years, the financial system presents itself as a service industry. It intermediates between savers and borrowers. It allocates capital to productive uses. It manages risk. These are real functions. They are performed. But the financial system is also simultaneously a rent extraction machine operating on the entire economy, charging fees for transactions, earning spreads on every flow of money, collecting management fees on assets, whether or not those assets perform, and distributing those fees upward while distributing the risks of those activities outward onto clients, counterparties, and ultimately the public. During normal times, the rent extraction is invisible because the system is producing. The fees are justified by the activity. The activity is producing returns, at least in aggregate, at least on paper. The crisis strips the paper away. It reveals that much of what was called return was leverage, borrowed money amplifying gains that were not as large as they appeared, and that the risk of that leverage had been quietly transferred away from those enjoying the returns and onto everyone else. Crises are not failures of the financial system. They are the financial system working at its full potential, extracting at maximum rate until the extraction exceeds what the underlying economy can support, at which point the extraction is socialized while the profits already extracted remain privatized. After the crash comes austerity, not for the banks, for the public. The argument is always the same. The rescue of the financial system has increased public debt. Public debt must be reduced. Reducing public debt requires cutting public spending. Cutting public spending means less healthcare, less education, less public infrastructure, less support for the people at the bottom of the economy whose position was already defined by the structures we have spent this entire series examining. The financial crisis becomes a justification for accelerating the redistribution of resources upward that was already the direction of the system before the crisis began. The crisis did not interrupt the direction, it accelerated it. Now bring this into the texture of your life, because financial crises do not feel like abstractions when they arrive. They feel like the job that disappears, the mortgage that cannot be paid, the pension fund that was invested in instruments nobody understood and is now worth half what it was, the neighborhood that empties as people leave for work that no longer exists, the decade of diminished opportunity that follows for people who did nothing wrong, who made no reckless bets, who simply lived inside an economy whose foundations were being hollowed out by people they never met, making decisions they never approved. The 2008 crisis reduced the median household wealth of American families by decades in the space of 2 years. For black families in the United States, whose wealth had been disproportionately concentrated in home equity, itself a consequence of the history of financial discrimination, that had limited access to other forms of asset accumulation, the destruction of wealth was even more severe. The crisis was not neutral in who it hit. It landed on the fault lines that already existed, it deepened them, and then it ended. For the institutions, and the next cycle began. The question that stays open after you have seen this once and cannot unsee it is not what to do about it. That is a genuine question, but it is not the first one. The first one is simpler. You live inside this system. You work within it, save within it, borrow within it, depend on it for the stability of the money in your account and the value of whatever you have managed to accumulate. And the system, by its own demonstrated history, will do this again. Not if, when. The cycle is in the architecture. The incentives are in the structure. The rescue script is written and rehearsed. The question is not whether you believe this. The question is, knowing it, what does that change about the way you are living right now?